Welcome to week 6, and this is our Chapter 2 lecture on financial statements, taxes, and cash flow. There are 4 major topics covered in Chapter 2, sorry. The balance sheet, the income statement, taxes, and cash flow. First, we're going to look at the balance sheet. A balance sheet is a very important document. It's a snapshot of the firm's assets and liabilities at a given point in time. So remember, this is about a given point in time, at time X. So think of it as a picture. Assets are listed in order of decreasing liquidity. In other words, the ones that you can convert to cash more quickly are listed first, and the ones that you can convert to cash less quickly are listed following that. Liquidity, again, is the ease of conversion to cash without significant loss of value. So these are some good terms to remember. The most important relationship you can bring to this class, well, from your accounting if you've had accounting, or that you can gain from this class, is the formula of the balance sheet identity. This is very important. Total assets equal total liabilities plus stockholders' equity. So what you have is equivalent to what you owe on it and who owns it. And so what we look at in the income statement is slightly different, but this is really is about how a firm handles the value of the owners in terms of the assets that exist and how it handles its indebtedness. If we look at figure 2.1, this is a pretty good figure. We can see that the total value of assets consists of current assets plus fixed assets, things tangible fixed assets and intangible fixed assets. And these are used to generate net working capital. And we use some of this in our current liabilities. But if we look at our liabilities, we can see that they're similar to the assets. There's current liabilities and there's long-term liabilities. And then we have shareholders' equity. So the idea here is to balance these out. These must balance at a given point in time. The value of the assets must equal what is owed to purchase these assets, or what is the ownership share. Net working capital, another term, is current assets minus current liabilities. Net working capital is positive when the cash that will be received over the next 12 months exceeds the cash that will be paid out. That's usually positive in a financially healthy firm. Firms that have negative net working capital over long periods are usually bankrupt within 2 to 3 years. Liquidity is another important concept. Liquidity is the ability to convert to cash quickly without a significant loss in value. Liquid firms are less likely to experience financial distress because they can get the cash they need to run the business rather easily. But the problem here is that liquid assets typically earn a lower return. So there's a trade-off here between liquidity and return. It's tough to find a balance that will give you the performance you need in terms of return. And so one of the financial decisions that you have to make is, how do we find a balance between liquid and illiquid asset? This is an example of a balance sheet that we can see here at assets. It's a very simplified balance sheet, but we see on the left side the assets, on the right side liabilities and owner's equity. And we can see here, this is the standard presentation, how it changes over time. And so we can tell what the managers of the corporation are doing to manage their debt, to manage their assets, and to make sure that they are preserving owner's equity. The real key here is understanding balance. And that's really what a balance sheet is all about. It's about balance. It's about maintaining assets in alignment with owner's equity and liabilities. There's another form of balance, though, that's important because when we look at share price, there are 2 different forms of value. One is book value, and one is market value. And book value is the value shown on the financial statements that are submitted to the Securities and Exchange Commission, but market value is the market on the stock exchange. The balance sheet provides the book value, the assets, liabilities, and equity. However, market value is the price at which the assets, liabilities, or equity can actually be bought or sold. Many times, in fact, almost always, these are different. And it's important to recognize this because the decisions that you'll make as a financial manager or even as an environmental manager will hinge on market value primarily, whereas the balance sheet is a sort of standard report. They're very different. They're different because of expectations of future earnings. And it depends on what decision you're making as to which is more important. Longer term decisions tend to revolve around book value, while shorter term decisions tend to revolve around market value. Now we're going to take a look at the income statement, which is the second in our statements. And the income statement is really more like a video of the firm's operations for a specified period of time, more usually a year. And companies generally report revenues first and then deduct any expenses for the period. The matching principle, generally accepted accounting principle, says that a firm should show revenue when the revenue accrues and match the expenses required to generate the revenue. So we get a reasonable idea of costs. If you don't match revenues and costs, then the video of what's actually happening is very inaccurate. Here's a standard income statement. This is very simplified, but we see that we start at the top with net sales, and we look at what it costs to provide the goods sold. We look at the depreciation of the assets that were used in the production of the goods, and then we have something called EBIT, or earnings before interest and taxes. We pay interest on our debts, which is why we want to keep those as low as possible. And then after interest, we have something called taxable income. Taxable income, then we subtract taxes, and we get something called net income, and this is known as the bottom line. And then net income is used for two things generally. It's used for dividends to stockholders or retained earnings, which in turn can be kept or used to reinvest into the business. Taxes are another critical element of understanding financial statements. And the only thing that we can rely on with taxes is that they're always changing, and this is very true. The tax codes are constantly changing. The key concept here is marginal versus average tax rates. The marginal tax rate is the percentage paid on the next dollar earned. So if you earn one more dollar, will that put you into a higher tax bracket or lower tax bracket? And the average tax rate is the overall tax bill divided by taxable income. There's other taxes too, such as state and local. But for our understanding, we're just going to consider basically the federal tax. Just like personal tax rates in the United States, corporations pay taxes on their taxable earnings. What the real difference is that it's much simpler. A significant difference in tax categories is corporations. We can see here that these are the 8 categories that go up pretty high. So what the idea is that through various components of the income statement, you want to minimize your tax liability. So there's these 8 categories can show you clearly where you fit, and the bands are rather wide here. So it's interesting to see that over 18 million, you actually drops again, which is I think one of the more recent developments. The marginal tax rate is the tax rate you would pay if you had one more taxable dollar, while the average tax rate is the tax rate you are paying on all of your taxable income, which averages across all the corporate tax categories. And these are very different. If we take a look at average tax rates, they vary quite a bit. And some of what we're going to see is this has to do with not only the internalized costs of environmental management, but as subsidies to the industry. And so you can see that the average tax rate is very, very different. Look at pharmaceuticals and biotechnology versus electric utilities. And you can see that the tax rates are hugely different, and a lot of this again is on subsidies and previous arrangements with the state, local communities, as well as grants from the federal government. There are lots of different tax incentives, and so we have to be aware of these and the tax implications anytime we make a decision that impacts these financial. Finally, cash flow is one of the most important steps that we can look at in terms of financial management. It's one of the most important pieces of information a financial manager can derive from financial statements. But the statement of cash flows is a little bit different in terms of information from the income statement and balance sheet. It's another form of information that both investors and employees can use, and stakeholders can use as well, to understand what exactly management is doing with the financial assets it has at its disposal. The statement of cash flows looks at how cash is generated from utilizing assets and how it is paid to those that finance the purchase of the assets. So the cash flow identity is very important. It's cash flow from assets equals cash flow to creditors, people to whom the company owes money, plus cash flow to owners. So the cash flow from assets, where does it come from? It comes from something called operating cash flow minus net capital spending minus net change in net working capital, where the operating cash flow is the earnings, the EBIT, plus depreciation minus taxes, and the net capital spending is the change in assets plus depreciation. And the change in net working capital is the ending versus beginning net working capital. And so the important part here to remember is that cash flow from assets tells us exactly how the managers are using the assets of an organization, where the cash is coming from and how it's being paid is shown in the cash flow identity. Cash flow to creditors, where the how much interest we're paying versus how much we're borrowing, and then cash flow to stockholders, how much new equity have we raised and how much dividends have we paid. There are some ethical issues. For example, why is manipulation of financial statements not only unethical and illegal, but also bad for stockholders? Well, it distorts the investment markets, and we see this in some of the recent examples and scandals of WorldCom and Enron, as the financial statements were using something called mark-to-market values, which distorted the true picture of the finances of the company. When it was actually insolvent, it showed it as being very strongly solvent. And investors were encouraged to invest, and as a consequence, they lost all of their investment money. So the terminology for this chapter, you need to understand the book value of a company, market value of a company, the term net working capital, liquidity, the marginal tax rate, the average tax rate, cash flow from assets. And so the most important topics, the things that you really should focus on in your studying, what's the difference? Know the difference between a book value and the market value of a company, and be able to compute the average and marginal tax rates of a company. Know the difference between those two. Be able to compute the firm's cash flow from its financial statements. I don't expect you to be able to do this in detail, but just understand where it comes from. If you have any questions, answer them or ask them in the Q&A thread on the class website, and we'll take a look at them. So we'll see you in class.